Hi, my name is Rajesh. I'm a direct lender based in Los Angeles, specializing in 2 to 8 unit multifamily buildings. And let's see here. A client asked me to redo the numbers on a building I'd previously priced out. You can see what it is over here: 40% down, 52% down, and 30% down. Some with a 5.5 down, 0.5 down, and 1 year prepaid penalty. The reason we do that is because we want to know, find a balance between cash flow and minimum down payment, least money out of pocket. So first thing I'm going to do here is, even though this is the price, he wanted a price at 2.6 million. So let's go here. 2.6 million. How many units is 8 units? So this is 8 units. It's got one vacancy here. So we're gonna put down that. Let's see what the gross rents. 2,400 a month right there. Now we have to sum up what the actual rents are for the remaining units. So 1,993 plus 1,982 plus 1,490 plus 996 plus 2,250 plus 2,150 plus 2,250, 14,111. And depending on the guidelines for the investor we choose to go with, they can, use market rates, at which point we're looking at $16,511 a month as gross rents. On others, they may say we only count 75% of market rents on vacant units. So that's what that vacancy discount is. Property tax and landlord insurance, this is again at $1,100 a month per unit on an 8-unit property. We're looking at roughly $8,800 a month. Close to it. Property taxes, I'm doing that at 1.25% and maybe lower, but this guarantees that when we're underwriting it, if it does come back at 1.25%, we're safe. We know that it's not going to come back in at higher than 1.25% of the purchase price. All these things don't really matter unless you're just looking at cash flow. I'm looking at this as an underwriter, and I want to make sure that this thing qualifies. So right here's the tricky thing about this property, right? If we go with a bank loan, they're going 60% down. He wants to know, my client wants to know here, 30% down. 2.6 at 30% down. So what do these numbers look like, right? So at 1.0, we're actually going to get closer to an 8.25% interest rate. And now you're at 36% down. Still not a good number. If we're at 6.625, now we're at 25% down. But we still we need to get at least a 1.1 to get a 5.75% interest rate with a buy down. So here we can say, okay, let's see, we get to 70. Now we're there, right? Now the buyer is only going to be losing $1,700 a month on this. And that's assuming, again, all these other operating expenses exist. We can easily go 0, 0, 0. That probably isn't going to change. She's going to be self-managing. Maintenance, zero. Pest control is not going to change. Legal, advertising. Legal, even she keeps all the same tenants, doesn't want to evict any of them. So really, it's going to be trash pickup. That's going to be the non-negotiable here. And if she cuts all that, she's going to be cash flowing $840 a month at this. The challenge here again is to get it at 1.1, keep it at 70% down, and we're looking at a 5-point buy down here. So when it comes down to it, you're roughly going to be paying the same. You're roughly going to be paying the same here. Now let's say this client doesn't want to do a buy down, right? So we go 6.625% here. Let's see what that looks like. They're going to have to get a 1.2 DSCR ratio to make that work. So they're going to have to come out of pocket $1 million, roughly, or 41% down. And here 39% down. So if we update this to 1.2, let's see, that's pretty close. So their cash flow is going to be more or less pretty much equal if they do a bank loan versus a DSCR loan. And they'll probably get a better interest rate on the bank loan at this point than as a DSCR loan. So 5.8% there. What I've got to do now is put on my salesman hat as a mortgage loan officer and come up with a better deal than the bank, which is put 40% down and get a 1.2 DSCR ratio and get approved. So right here is probably the best strategy, because now she's saving $100,000, and she's going to have to use 5 points to buy down to that interest rate. But what you're not looking at is that the seller can pay for that interest rate buy down through seller concessions. And why would they do that? Well, if the building's having a hard time selling, and right now a lot of buildings are having a hard time selling, they're cutting prices all over, even in Los Angeles. So this is a really good time to buy.